What are you going to be watching for in terms of commentary and the path forward after today?
Thanks for having me. As very rightly mentioned, by you and your colleague, this meeting is not about rate action. This meeting is clearly about what the commentary is, how the tone of the statement is, and what the governor says during his address. There will be two or three things which we will watch out very carefully. This is the policy meeting where they will give, for the first time, inflation projection for June 27 quarter. Now, this is important because in the last policy meeting, they gave an above 5% inflation projection for December as well as for March 27 quarter. If they see it persisting going in the June quarter, also, then that can be indicative of higher inflation risks. The second thing would be on what they say when it comes about inflation persistence. Last time, the governor was very clear when he said that a spike towards 5.9% inflation in December is temporary, and after that it comes off. But there has to be, we will be watching out in case if there are any commentary which indicates that their sensitivities to upside risk to inflation is increasing, given that supply risks are becoming frequent rather than one-off. We have the El Nino risk, which you spoke about. As very rightly mentioned, there is an improvement, but sowing is low, and the more important part is that reservoir levels are low, and weather is expected to become drier in another couple of weeks. The second is, overnight we did hear good news around the geopolitical uncertainty as well as on oil prices, but is it here to stay? So given these uncertainties around supply risks, I think what they have to say will be extremely important to assess if there is any change in their sensitivity to inflation persistence, or do they stick to their word that inflation spike is just one-off.
Yes, forecasting is a challenging job at the best of times, made even more complicated when we're talking about variables like monsoons or the current security situation around the Middle East. So with that in mind, I mean, how are you modelling inflation for the coming quarters? Because it is so difficult to predict what might happen. We've had some encouraging news today, yes, but we've been here before, haven't we?
Absolutely. So I think if we look at MPC's forecast of inflation for June 26 and September 26, that has definitely surprised on the lower side. During the June policy meeting, we clearly highlighted that RBI is forecasting inflation at the higher end, and we think they will go and revise down their inflation projection in this meeting marginally, but that marginal downgrade of 10-15 basis points is likely to come with strong hawkish commentary around upside risk to inflation to ensure that the signaling to the market is right. Our view is very similar to RBI in terms of the December and the March inflation trajectory. We also expect December quarter inflation at 5.9% and March quarter inflation anywhere between 5.25 to 5.40. As I mentioned earlier, our view is what would RBI project for the June quarter. Right now, we think it would be, trading closer to 5%. But if RBI projects a number which is higher than 5%, then I think market would become more confident that probably we can see some rate hikes later, if not just as of now. The risk to watch out is if El Nino turns out to be far more intense than what RBI has penciled in its forecast and what we have penciled in our forecast. If that happens, then instead of, say, staying below 6% in the December quarter, if inflation actually surges above 6% and stays there for 3 to 4 months, then the inflation trajectory can look very, very different. And then the rate reaction function also will look different. So I think the risks are far more important to watch out for rather than what the model-based inflation trajectory are saying just as of now.
Where do you place the chances that the RBI ends up remaining on hold for an extended period if inflation risk does moderate?
If If inflation risks moderate, then there is a fair, like a high level of probability that RBI might stay on hold. That is our baseline because our inflation projections are very similar to RBI, and RBI and MPC have clearly stated that they want to use the inflation, they want to manage inflation only via a repo rate, as repo rate as the tool. They do not want to deploy repo rate as a tool to manage FX risks or in order to attract capital flow. So they have made this distinction very, very clear, which works well in our view during times of certainty. But during times of uncertainty, we think somewhere if the capital flow story, even if the inflation trajectory is comfortable, if the capital flow story turns out to be weaker, then they might be pushed to go ahead with couple of rate hikes. That's a risk scenario. That's not a baseline scenario, and they can very well coincide it or make it coincidental with higher inflation prints, which are likely to happen in the December and the March quarter.
Where would you place the chances of the RBI lifting the rate to defend the currency? I mean, it's not exactly within the mandate, but it would prevent imported inflation. How likely do you think that is? Where do you see the rupee heading from here, linked to that?
Yeah, so I think on the using interest rate as a tool to defend currency, when the fundamental problem is inadequate FDI flow, I think that has its limitation. And there I clearly sympathize with RBI's view that hiking rates will not alone contain the pace of depreciation. The problem for India is lack of capital flows on AI theme, higher global yields, etc. And they cannot be addressed just by hiking rates continuously, because debt investment in India is far more limited than equity investment. Having said that, I think, as I mentioned before, our baseline scenario is of no hikes, but we do believe that somewhere rates have to be raised by, by 50 basis points or slightly more to disincentivize substituting dollar borrowing with rupee borrowing. That also will help capital flows, even if it is helping at the margin. From a rupee perspective, we are extremely cautious on rupee. The FCNR scheme is valid or runs till September end, and hopefully we have got good flows till now. We'll keep on getting good flows, but once the September deadline is over, the momentum in capital flows is likely to weaken, and that is likely to bring back focus and would weigh down on rupees. So our year-end forecast is 96, but we do see risk of it trading at a much weaker level than what we are forecasting because of uncertainties on oil prices, plus, and the most important part, on lack of visibility that capital flows to India, whether it is through the portfolio investment channel or the FDI channel, would turn around in a big way over the next 6 to 12 months. The key thing to watch out here is if government and the RBI come out with another set of measures to attract capital flows. When they announced this whole scheme on June 5th on FCNR and commercial borrowings, etc., both the finance minister and the RBI governor highlighted that there are more measures which have been considered to bring in capital flows onshore. Till now, we have not heard anything, and it makes sense because money continues to flow in. So if they announce something more substantial, then the story can be different. But based on information which we have as of now, we remain cautious on rupee and see rupee trading at a weaker level going forward by end of the year.
To what degree do you think the RBI is going to have one eye on the Fed as well? Because, for now, there's still an expectation we'll see some tightening from the Fed before the end of the year. Do you see that influencing the RBI going forward in any way?
I think, it would depend a lot on whether Fed hike, like the whole context of that Fed hike. If Fed hikes by just 1 or 2 times and it coincides with lower inflation, easing capital flow pressure on, easing capital flow pressure coming to India, then the need to hike might not be there. But if it coincides with higher inflation trajectory and continued pressure on capital flows, then I think RBI would definitely react to it. So it would depend a lot more on the context. But as I mentioned earlier, I think the baseline or the best case from the Fed's perspective, and that is what our house view is, that they will not go and hike rates. But even then, even if they're not hiking rates, the U.S. Treasury yields are trading at elevated levels, and that is a challenge to get capital flows back in the country. So we do we do see a risk that RBI might use the opportunity when inflation is higher to just give a couple of rate hikes just to ensure that some capital starts flowing in as it becomes less attractive to substitute dollar borrowing with rupee borrowing. This is a risk scenario, not the baseline, but hopefully we can see something on that front going forward from a medium-term rupee support perspective.